You know, some people think real estate investing is all about location, location, location. But what if I told you it's actually about leverage, leverage, leverage? In this video, we'll explore how leveraged appreciation can turn a $50,000 investment into $500,000. And just when you think you've got it all figured out, we'll throw in a curveball that might just knock your socks off. Now, I know what you're thinking. Joe, that sounds too good to be true. But stick with me because I'm about to show you the power of leveraged appreciation in real estate. This isn't just some theory. It's a strategy savvy investors use to grow their wealth. Why is this so important? Because if you do not want to work a job for the rest of your life, you must be able to grow your wealth. Whether you're a first-time investor or a seasoned pro, understanding how to make your money work harder for you is crucial. So let's dive into the secret weapon that can turn your $50,000 into a real estate goldmine. Now that we've talked about the power of leverage, let's break down the math behind this real estate magic. You might be wondering, Joe, how exactly does leveraged appreciation work? Well, I'm about to show you why this strategy is a game changer for smart investors. Leveraged appreciation is like having a financial superpower in the real estate world. It's when you use borrowed money to amplify your returns on a property's value increase. Sounds simple, right? But the impact can be massive. If you've been following me for a while, you know I often discuss the benefits of real estate investing, real estate frequently asked questions, and current housing market conditions, because I have found that informed consumers make smarter decisions when buying or selling a home. If you're not a subscriber, please click the thumbs up like button and subscribe now to get all my new content when it is fresh. If you really want to know what's going on in housing, to see and hear the data explained, to learn the tips and tricks that put extra money in your pocket, then subscribe now and I'll keep you in the know. Now, I know we've been talking about the incredible potential of leveraged appreciation, but let's pump the brakes for a second. You might be wondering, Joe, if this is so great, why isn't everybody doing it? Well, that's a smart question, and it brings us to an important point. Leveraged real estate investing is a double-edged sword. Sure, it can supercharge your returns, but it also comes with risks that you need to understand. Remember, we're dealing with borrowed money here, and that can be a powerful tool or a dangerous weapon, depending on how you use it. Let's talk about market volatility. The real estate market isn't always a smooth ride. It can be like a roller coaster with ups and downs that can make your stomach turn. When you're using leverage, those ups and downs are amplified. A 5% drop in property value might not seem like much, but when you're leveraged, it could wipe out your big chunk of your equity. Here's something that keeps many investors up at night. Negative equity. Imagine owing more on your mortgage than your property is worth. It's not a pleasant thought, is it? This can happen if property values drop significantly, and it's a risk you need to be aware of when using leverage. But wait, there's more to consider. Cash flow is king in real estate investing. When you're leveraged, you got mortgage payments to make, regardless of whether your property is occupied or not. If you can't cover your mortgage and other expenses with your rental income, you could find yourself in a tight spot real quick. And let's not forget about interest rates. They might be low now, but what happens if they rise? Higher interest rates mean higher mortgage payments, which can eat into your profits or even push you into negative cash flow. So, am I trying to scare you off of leveraged real estate investing? Not at all. I'm just making sure you go in with your eyes wide open. Because here's the thing. With the right strategies, you can mitigate these risks and still reap the rewards of leverage. First off, do your homework. Research the market you're investing in. Look at historical trends, future growth projections, and economic indicators. The more you know, the better equipped you'll be to make smart decisions. Next, don't over-leverage. Just because you can borrow 80% doesn't mean you should. Consider putting down a larger down payment to give yourself a cushion against market fluctuations. Diversification is another key strategy. Don't put all your eggs in one basket. Spread your investments across different properties or even different markets to reduce your risk. And here's a big one. Always have a cash reserve. This can be a lifesaver if you face unexpected vacancies or repairs. Aim to keep at least 6 months of expenses set aside for each property. Lastly, consider fixed-rate mortgages over adjustable-rate ones. They might cost a bit more up front, but they protect you from interest rate hikes down the road. Remember, leveraged real estate investing isn't a get-rich-quick scheme. It's a long-term strategy that requires careful planning, a diligent management, and a solid understanding of the risks involved. But if you approach it wisely, it can be a powerful tool for building wealth. So now that we've looked at both sides of the leverage coin, you might be wondering how to time your entry into the market. Is there a perfect moment to jump in? Well, that's exactly what we're going to cover next. So, we've covered the power of leverage and the risks involved. But there's one question that keeps popping up in my inbox. Joe, when's the right time to jump into the real estate market? It's a great question, and today we're going to tackle the age-old debate of market timing in real estate. You've probably heard the saying, time in the market beats timing the market. But does this apply to real estate too? Well, let's look at some cold hard facts. Historically, real estate markets have shown cyclical patterns. We've seen boom periods where prices skyrocket, followed by corrections or even crashes. The 2008 housing crisis is a prime example. But here's the kicker despite these ups and downs. U.S. home prices have consistently trended upward over the long term. Now you might be thinking, Joe, if I can predict these cycles, I can make a killing. And sure, if you had a crystal ball, that'd be great. But here's the reality. Even the experts struggle to accurately predict market turns. It's like trying to time the stock market. Sounds great in theory, but it's incredibly tough in practice. So, what's the alternative? Well, let me introduce you to a concept called dollar cost averaging in real estate. It's a strategy where you invest consistently over time, regardless of market conditions. This approach can help smooth out the impact of market fluctuations. Here's how it might work in real estate. Instead of waiting for the perfect moment to buy, you invest in properties at regular intervals. Maybe you buy a property every year or two. Some years you might buy at higher prices, others at lower prices, but over time you're likely to average out to a good entry point. Remember, the average annual appreciation rate is about 5%, so time will take care of timing. Now, I know what some of you are thinking, but Joe, what if I buy right before a market crash? It's a valid concern, but remember, real estate is typically a long-term investment. If you're in it for the long haul, short-term fluctuations become less significant. Let's look at some numbers. According to the Federal Reserve Bank of St. Louis, median home prices in the U.S. have increased by 1,070% since 1963. That's an average annual increase of about 5.4%. Now, this doesn't mean every year saw a 5.4% increase. Some years were higher, some years were lower, and some even saw declines. But over the long term, the trend has been upward. So, what's the takeaway here? While timing the market perfectly would be ideal, it's not realistic for most investors. Instead, focus on time in the market. The longer you hold your real estate investments, the more likely you are to benefit from overall market appreciation. And here's a pro tip. While you shouldn't obsess over timing the entire market, you can focus on timing your local market. Pay attention to local economic indicators, job growth, and development plans. These factors can give you insights into potential up-and-coming areas where your investment might see stronger appreciation. Remember, real estate investing is a marathon, not a sprint. It's about making informed decisions based on your financial goals, risk tolerance, and local market conditions. So don't get too caught up in trying to time the perfect entry. Instead, focus on finding good deals, managing your properties well, and holding for the long term. Now, you might be wondering how real estate stacks up against other investments over the long haul. Well, that's exactly what we're going to dive into next. And let me tell you, the numbers might surprise you. All right, we've covered a lot of ground, but I've saved the best for last. You might be thinking, Joe, how does real estate really stack up against other investments? Well, I'm about to show you something that just might blow your mind. Let's talk about real estate versus stocks. Now, I know what you're thinking. Stocks have been the go-to for building wealth for decades. But here's the kicker. When we look at the numbers, since 1963, leveraged real estate has been quietly outperforming stocks, and not by a small margin. Here's the deal. Since 1963, median home prices in the U.S. have shot up by 1,070%. That's an average annual increase of 5.4%. Now that might not sound earth-shattering, but remember, we're talking about leveraged appreciation here. Let's break it down. If you put 20% down on a house, that 5.4% annual appreciation turns into a 20% or more return on your initial investment. And that's before we even factor in rental income or tax benefits. But wait, there's more. When we compare the annual real estate appreciation rate to inflation, with housing removed from the inflation equation, we see that real estate has consistently outpaced inflation. This means your investment is not just growing, it's growing in real dollars. Now, let's talk taxes. Real estate investors get some sweet tax advantages. You can deduct mortgage interest, property taxes, and depreciation. These deductions can add up to another 2 to 3% in annual benefits when leveraged. So, what's the bottom line? When you add it all up, appreciation, leverage, rental income, and tax benefits, real estate can potentially deliver returns that make the stock market look like small potatoes. But here's the thing. I'm not telling you to dump all your stocks and go all in on real estate. Diversification is still key. What I am saying is if you're not considering real estate as a serious part of your investment strategy, you might be leaving money on the table. You want to dive deeper into real estate investing? Check out my previous video, 6 Real Estate Investing Lessons Learned from the 2008 Housing Bubble. Discover how a crisis that wiped out fortunes can actually provide invaluable insights for successful investing. Join us on this journey through the 2008 housing crash and uncover the wisdom that could safeguard your investments and set you up for unprecedented success.